All right, good evening, everyone. Welcome to tonight's webinar, How to Invest in the Stock Market Profitably. As a follow-up to our webinars earlier this week, we had one on Saturday, which was a sort of broad overview of how I trade the stock market. And then on Wednesday, yesterday, I did one on active trading, on day and swing trading. And for those that are interested, from yesterday's webinar, today's picks for that strategy I talked about yesterday called the Alpha Echo, which is my sort of favorite strategy right now. It had another real strong day. The biggest winner was MNTS, which was a pick at 943, and it went up on the sell probably about 8 times risk. So for every $100 risk, about $800 of profit, and we can I might be able to show you that chart a little later. But tonight is all about investing. So for those who want to do longer term trading where you're holding for weeks or months, we call that position trading, and that's what tonight is all about. So what are we going to do? I will spend a little time defining my approach to position trading. I'll give you the theoretical breakdown of how it works, why it works, and then I'll ultimately, as we go through the presentation, teach you how to know what stocks should be bought, what stocks should be avoided, and that's also very important, especially right now because the market's generally trending lower. So most stocks should be avoided, and I'll teach you how to know that. We'll talk about how to manage risk in stock trades, how to know where to put stop losses in, how to size positions, that sort of thing. Ultimately, we're going to do some market scans using the Stockscores market scan tool, and I'll show you that tool. And we'll also do a couple of scans. We'll do a scan where you would look for stocks that have a good potential to go higher. And then I'm also going to build a scan that will look for stocks that pay a good dividend and have reasonably stable charts. So for those people who just want to gather income from their stocks, there's some big dividend payers out there right now, particularly in the Canadian oil market, stocks yielding 6, 7, 8%, and I'll show you how to find those with the tools that we have. I will explain how I can help you in the market, how I can teach you how to be an investor, a trader, manage your own portfolio, make a living from trading the stock market. I'll give you a quick 5 minutes on that. And then at the end, I will invite your stock questions. So if you have a stock that you want my assessment on, you can put in the symbol. Don't do it now because it'll get lost. So wait until I ask for them. But I will, we'll do maybe 3 or 5 stocks, and I'll give you a read of those charts and give you a sense of not only how to do it, but my expectations for those stocks. Okay, so someone's saying that my screen is black. I have a feeling that's not the case. If that's the case for you, just log out and in again. That usually fixes the problem. All right, so let's get right started now. So the theory behind the Stockscores approach, our aim, very simply, is to find market-beating stocks. If you're not going to find market-beating stocks, if you're happy to earn the return of the market, then you don't really need to do any effort. You just go out and buy a low-cost indexed ETF or an index mutual fund and earn what the market earns. And that's not a bad approach. You know, historically, the stock market has averaged about 8% per year over, the long term. But that's not what I'm interested in. I want to beat the market. I want to earn, if the market earns 10%, I want to earn 15 or 50. Obviously the higher the better. And so we're all about beating the market. Well, in order to beat the market, you have to find stocks that move faster than the market. And we call those alpha stocks. These are the stocks that capture investor interest and can really make the big moves in a relatively short amount of time. And so I'm going to show you some tools and some concepts on how I do that, but it's all about finding those stocks that can move faster than the market. So if we look at this chart here, you can see an example of a stock that obviously moved faster than the market. It went from $2.60 in August to a high of $5.60 in September. It went right back down again very quickly, but that's okay. We can be a seller of the stock right there at about $5. And I will teach you why the stock was a buy here, why it was a sell here. And this, of course, is an alpha stock. It's a stock that's, as we talked about in last night's webinar, it's an alpha stock. It has the characteristics of alpha, which are abnormal trading volume and then strong price gains. And so I'll explain a little bit more about that, but that's our basic concept that we want to try and do tonight. So why does that happen? Why do stocks move in strong trends? Why did they move faster than the market? Well, typically it's because there's something specific to the company that has investors excited. And so there's some fundamental element in the company story that is positive, or at least the perception is positive. We've seen many stocks that go up and right back down again, and you can make lots of money on those types of companies. But oftentimes it's a little bit fake, I guess. The pump and dumps, that sort of thing, where you have these stocks that move up on hype, and there's really nothing fundamentally good about them, but they can still move up very, very quickly. And really, we shouldn't care why the stock moves up. If it moves up a lot, we can buy it at $2 and sell it at $4. Do we really care why? The main reason people don't like those kinds of stocks is because they don't know when to sell them. And so they'll ride them up, and then they'll ride them right back down again, and they'll miss out on the gain. So I'm going to give you some lessons on how to know when to buy and also how to know when to sell. We'll look at a few examples of that. And we can use some simple techniques. I'll give you a couple of those tonight, and obviously there's more than what I can talk about in a 1-hour presentation, but I'm going to try to give you some things that you can take away from tonight and apply tomorrow. All right, so stocks move in strong trends because they have something significant going on in the company, and that will usually create excitement. Investors will gather around that company and want to buy it aggressively. Sometimes it can be the whole sector is strong. And so lately, we've seen that in uranium stocks. They have done quite well over the last few months, and that's really a sector play. There's, perhaps increase in uranium prices. There's a movement back towards using nuclear energy to make electricity. And so that creates the demand for uranium, obviously. And so we've seen a lot of uranium stocks go up. It's not so much something specific to the company. We're not talking about the company going out and finding a new uranium deposit. These are companies that already have uranium. And the reason they're going up is the commodity prices are improving, or the outlook for the industry is improving. So either of those things can drive market outperformance for a stock. Usually it's the stock specific stuff, and sometimes it can be the sector stuff. Now, in the market that we have today, it's really important to have alpha because the overall stock market has been going down more or less since the start of 2022. We went down through most of 2022 as interest rates rose. 2023, we stabilized a bit. We had a little rally in this past summer, but for the most part, we haven't had a great upward trending market since 2021. And we had a great market to the upside from 2020 into 2021. I call it the COVID recovery rally, and it generated just some amazing gains for position traders. Now, one thing to keep in mind is that really hot market that we saw in 2020 and 2021 came after a very sharp sell-off. And we see that quite often. When markets have very strong sell-offs, they will often then set up for the next big bull market. And so although it's not been fun riding the downward trending market of 21 or 22 into 2023 here, it does set up for the next rally because as prices fall, stocks get more attractive, the valuations get better, and eventually the buyers start to step in again and you get the next wave. And the market does tend to move in waves, up wave, down wave, up wave, down wave. And so something I always like to remind my students is that the best markets come after the worst markets, and the worst markets come after the best markets. And so when you've got a market that's really strong, you should realize that soon it will turn lower as people take profits. And likewise, when the market's been weak for a while, you should realize that soon it will turn as valuations get more attractive and there's going to be a catalyst for the next wave up. All right. So here is a stock, interestingly enough, a uranium stock. This is Cameco, CCO, also trades in the US as CCJ. And you can see that it made a little breakout from an ascending triangle pattern. Much like we talked about last night, it had abnormal volume and an abnormal price move. So that's one of the key ingredients for a stock to be bought. We want to buy stocks when they break through resistance from optimism, from low volatility, and then they start an upward trend. So let me break that down a little bit more for you. So I said from optimism. So you may remember in Saturday's webinar, and we talked about it, I think maybe last night as well, this idea of inflection points. Inflection points are where the stock stops going down and starts going up. So you get these little valleys, okay? So those are inflection point lows. When those inflection point lows are rising from left to right, that implies that the buyers are gaining momentum and the buyers are gaining strength. And we can say that because every time the sellers are able to push the stock down, they're not able to push it down as far as they had the previous time. And the result is you get rising bottoms on the chart. So when you have rising bottoms, you have optimism. And when you have optimism, you have the buyers in control of the market, and that's setting up for a good buy opportunity. Now, that can be a bit misleading because we don't want to buy when the stock is up here, even though there is optimism, because what we also want is for the stock to generally be going sideways. So that's the low volatility component. We want a stock that has optimism, but is generally going sideways and has low price volatility. Because low price volatility tells us that the buyers and sellers have come to some agreement about what the stock is worth. So you can see here through the month of May, buyers and sellers agreed that this stock, Cameco, was worth between $36 and $38 a share. Now, investors were optimistic because we had rising bottoms, but there was a ceiling price here going back many months that the stock had not been through. The stock had not traded above $40 at any point leading into this breakout at the start of June. Now, we call that a breakout because it breaks through that ceiling price, that resistance level between $38 and $40. We had optimism, we have a breakthrough resistance, and notice also that the volume was spiking higher. And so the reason that that volume is spiking higher is because investors got excited about something. The news in the market, the rumors in the market suddenly made the buyers more interested in buying that stock, and they did so aggressively. So the people buying here are the people that follow the company and the industry the closest, and they could see, because they get better information, they could see that there was a potential for the stock to go higher. Now, the Stockscores, that's this line down at the bottom here. The green line is our sentiment stock score. For this strategy, we want the sentiment stock score to be greater than 60, which is the green line. And the blue line, we want it to spike up above 80. And so we have all those things coming together. We have above 60 and above 80, strong volume, breaking through resistance, from optimism, from sideways trading. And that is kind of the formula that I've been using for 20 or 30 years to pick position trades. And you can see in this example, we had this great move to the upside out of that. You know, the breakout occurs here at about $41, and it ultimately gave a sell signal just a week ago or so at, let's call it $52. So it's made about a 25% return in 3 or 4 months, and that means it beat the market, because in that same time period, the Toronto Stock Exchange was probably down, maybe sideways or down over that same period. Okay, so the next thing that we need to talk about is this notion that the stock market is not fair. And what do I mean by that? The spread of information, the information that different investors have access to, varies based on who you are, your proximity to the company, the amount of capital that you have to trade with, that sort of thing. You know, large investment funds have the resources to get better information than you or I as retail investors. Then, of course, there's the insiders. They get better information. There's the people in the industry who know the companies in that industry very well. They tend to have some better knowledge about these companies. And so when people have better information, they have an advantage in the market that they can act upon, and that allows them to pick stocks before most people have the new information about a company's ability to make money going forward, make money in the future. And so let's look at an example that really drives this home. What you see here on screen is a stock that had a big price gap about a week ago. So by price gap, I mean right here. One day it was trading at about $8, and the next day it was trading at $16. Well, the reason that happened was it was announced by this company, Orchard Therapeutics, that they were being bought by a Japanese pharmaceutical company for $16 a share. And so instantly, overnight, the stock jumped up from around $8 to $16 when the news came out. But notice that this stock actually started behaving abnormally about 2 weeks earlier. So why were people suddenly willing to pay $6 a share in the middle of September, when prior to that, no one had been willing to pay more than $5 or $5.50? You can see for months the stock was trading in around the $5 mark. So why would some investors suddenly be willing to pay $6? And then 2 days later, willing to pay $7. And a week later, willing to pay $8. This stock was moving up quite sharply before the news of this buyout came to market. And we see this often. We see the market often predict good earnings. We see the market predict mergers and buyouts. When Elon Musk bought Twitter, now X, the market moved before the buyout was announced. When Lululemon had better earnings than expected, the stock moved before the news came out. And it's not necessarily people trading on inside information. Often it's just people that follow the company very closely that make an educated guess, and they're right. They do good research, or big hedge funds, big investor funds who have lots of resources. They can, really do in-depth research. They can often uncover these big fundamental changes in companies and predict them. And the beautiful thing about that, and really my entire trading approach is based on this idea. The beautiful thing is that when someone knows something or believes that a stock is likely to move higher, they go into the market and they buy it aggressively. They create abnormal volume and they create strong price gains because they are willing to pay more than anyone had been willing to pay for some time. Just like there in the middle of September when ORTX made that price jump, that was because someone believed that this stock had great potential to go higher. And we don't have to know anything about what these companies do. To me, they're just symbols. But what we can trust is that the people who know the most are going to act in the market and they're going to leave a trail for us to follow. And so that makes it, as I discussed yesterday, really, really important to follow abnormal activity. All right, now the next thing we want to talk about is this notion that we should not expect to be right all of the time. And this is, I think, challenging for many people because we go into trades not wanting to lose. Nobody wants to lose on any trade. But to be successful in the market, you have to be a good loser. You are never going to be right 100% of the time. And in fact, you can be very profitable as an investor even if you're only right 50% of the time. Because think about it this way, if 50% of the time you average a 20% gain and the other 50% of the time you average a 10% loss, if you do 10 trades, 10 times you make 20% and out of 10 trades, 5 times you make a 20% gain on average and 5 times you lose 10% on average. After 10 trades, you've made money, even though you're not right all of the time. But the key ingredient in that is to not take big losses and to let your profits run. And so you have to have a methodology for picking stocks that have better potential than most. And I've touched on how to do that. We'll look at another example in a moment. And you also have to have a strategy for when to take a loss, which is a skill in and of itself. And I'm going to show you a method in just a moment. And you have to know when to sell. I kind of already showed you one method, which is the break of an upward trend line when we looked at the price run on Kamiko, CCJ, CCO in the different markets. So when you see the break of the upward trend line, good reason to sell. If the stock does not move up and instead moves down through support, like AMC did, like AMC did in here, okay, if you're buying this breakout that attempted there, we had some abnormal volume there, it broke out in the morning, I thought the stock was likely to go higher. I bought the stock then, but it failed. And so I took the loss when it closed below the last inflection point low. And that's the method for where you set your stop. So we talked on Saturday about inflection points. And if you haven't watched that webinar, then go to the Stockscores YouTube channel. It's on there from about a week ago, 5 days ago. So here you have a stock that has a floor right here, right? The stock hasn't traded below that floor. We'll call it $7 for simplicity. Hasn't traded below $7 for a few weeks. It tries to break out there. So you put your stop in at $6.90. I always like to go a little bit below the floor. So if the floor is at 7, I'm going to go a little bit below that, below the psychological barrier. So call it 690. Trade didn't work. You take the loss at 690. It's a small, manageable loss that's not going to hurt your performance in the long run. However, if you had ridden that stock all the way down, instead of losing, 50 cents a share, now you're losing $3 a share. And not only are you losing $3 a share, but you're tying your capital up for much too long. You could have that money in something else that's working. So it's really important to always plan to lose. And if the market hits your stop loss point, to get out, move on, go to the next one. Next important concept is when we are right, we want to let the stock work. We want to let the trade run. Now this can be challenging because we often are concerned that our winner is going to turn into a loser. And so we will often, a little bit of weakness comes into the stock and we want to sell it. Or it gets a little boring for a few days and we're tempted to sell. Well, the key thing is to wait until there is a sell signal. And one of the sell signals that's most reliable is the break of a trend line. So I can visually draw a line across these lows here. I'm going to try to draw a straight line. Let's do that again. There we go. And you can see that this line has repeatedly held up as the trend was moving. And then it made a strong and noticeable break of the upward trend line telling us that it was time to exit. And I would say that this stock still has more potential to fall because it's broken the upward trend line, and now today it started to break down from a falling top. And what do you think a falling top means? If rising bottoms mean optimism, a falling top means pessimism. And so we're getting falling tops on this stock, and that's a sign to avoid it. And this comes back to now another important lesson is to never buy stocks that are in the control of the sellers, where the sellers have control of the stock. And how do we know that? We know that is the case when the tops are falling on the chart. So for example, over here on the left side, the tops were falling, so you do not want to be a buyer. You do not want to be a buyer until the downward trend line is broken and you start to build rising bottoms. Okay, here again, downward trend line, broken, rising bottoms are starting to form. Rising bottoms continue to form, and then we get a breakout through resistance from low volatility, from optimism with abnormal activity. And there you go, stock goes up. I basically just explained to you the key components of how to pick good stocks and how to stay out of bad stocks. Now, not that simple. You need tools, you need some practice, you need to learn how to read chart patterns, but that's the basic concept. And this concept I've been teaching for 20 years, I've been doing it for 30. It works well. The key thing, however, is to have the discipline, the focus, and the tools to make it happen. So what do I focus on when I am looking for position trades? First and foremost, abnormal trading activity. But not all abnormal trading activity matters. We want abnormal trading activity from predictive chart patterns. So what are predictive patterns? Well, I teach about a dozen. The one that we've seen so far tonight is something called an ascending triangle. It looks like this. It's got rising bottoms, a flat top, and then a breakout. So that would be an ascending triangle breakout with abnormal trading activity here, the predictive pattern here. And then if you buy this, we're going to plan to lose here at the floor before the breakout. So that's the floor price, and that's our risk management. If it were to fall down through there, we're going to take the loss. That's being a good loser. If it doesn't fall down, and usually 70% of the time it doesn't, it keeps going up, we're going to stick with this trade until the trend line is broken. When the trend line is broken, we're going to take our money and we're going to move on to the next one. We are not trying to get in at the low or out at the high. If you try to do that, you will drive yourself crazy. You will get too emotional and you will not make good decisions. Our goal is to get the chunk of the move, not the whole move. We want the 80% of the move. We're going to miss the first day and we're going to be a little bit off of the top when we sell. But if you can do that over and over again, you're going to be successful in the market. So here's another example. We have a stock that's boring sideways trading, but it starts to build rising bottoms. So we have optimism building. Notice the stock scores are starting to get better, and then right here they spike up. And the reason they spike up is because I created the stock scores indicators to look for abnormal activity. And you can see it. You can see that there's an abnormal price jump and there's abnormal volume. There's optimism, there's low volatility, and there's a breakout through a ceiling price. And that starts the upward move. Now, in this case, we don't have a linear upward trend line because eventually it goes parabolic. When we get a parabolic trend, we want to be quite aggressive on the exit. As soon as we see this start to break down, like right here, we're going to sell. So we're not selling at the high, unfortunately. We're selling after the breakdown starts. We're buying here at 280, 290, and we're selling at $5. But we're also getting out before the thing falls apart. Because we have no illusions, these stocks often go right back down again. Who cares? If you can buy it at 280 and sell it at 5 and do that 10 times a year, you're going to do very well in your portfolio. And this is a type of strategy where you don't have to, do it all day long. It's a less time sensitive. You can do it for an hour in the evening. Once you practice, you'll do this for 10 minutes in the evening. And once you're really good at it, it'll take you 5 minutes. I'm going to show you the process that I use every day to find stocks like this. Okay, and that's, well, let's talk about the strategies first. So I've got 6 strategies that I teach for position trading. The Stockscores simple strategy is pretty much what we've shown so far with the 2 stocks that I've shown, is looking for stocks that have good stock scores, sentiment score above 60, signal score above 80, breaking from a predictive pattern. Stockscores action breaks doesn't require the stock scores to be in those zones, but it puts more emphasis on abnormal activity. Stockscores bottom fishing, we only do when the market's coming out of a downward trend. So we may be doing this one soon because the market's been trying to bottom. We're kind of doing this right now in the overall market. And the bottom fishing strategy says, look for the break of a downward trend line, the build of a rising bottom, and then the break up from a rising bottom. So that's the basics of the bottom fishing strategy. And then we have the abnormal breaks, which is abnormal activity without much emphasis on the pattern. Now, for those that only want to do this research work, say on the weekends, they don't want to do more than maybe 10 or 15 trades in a year. They're just trying to manage their retirement portfolio fairly passively. Then you would do all of these things, but on the weekly time frame. So on a Saturday, you might run the Stockscores simple weekly scan. If you only want to trade ETFs, you might focus on exchange traded funds, and you're just trying to find the leaders in the market. We're going to do a few scans in just a moment. So I use this tool called the Stockscores Market Scan. They say you should always scratch your own itch. And I don't know, 15, 20 years ago now, I needed a tool to do what I was doing manually that was taking me hours and hours and hours. And so I created my own tool because there wasn't a tool out there that looked for abnormal activity, that looked for some of these other things that we've talked about tonight. And so I went out and built my own, and that is something that you can use as well. It's a member-only tool on Stockscores. I'll show you that in just a moment. It provides filters that are unique to my approach. So it has filters for abnormal price gain, abnormal volume, breaking out, low price volatility. And we'll run a couple scans in just a moment. The biggest thing about the market scan is not only does it have these proprietary filters that you can't get anywhere else, but it's a huge time saver. It allows you to go through the entire market in 10 minutes. When you first start out, you might take half an hour to do it. We're going to do a couple scans in a minute. And once you've practiced for a while, you can do it very quickly. All right, so let's jump into the Stockscores website now. So here is stockscores.com, and I'm going to go into the market scan, and I'm going to run my Stockscores simple scan. So you can see here on the list, I've got Stockscores simple for Canada and for the US. So we'll start with Stockscores simple US, and then I'm going to do a dividend scan for Canada. So simple US, I just click on that, and it brings up the scan with all the settings populated. So you can see that signal score needs to be above 80, sentiment score needs to be above 60, and then there's a few other settings here on the screen that are important for that scan. So I'm going to run the scan. It goes through every stock that trades in the US, and it found 29 that have the basic criteria met. But we still need to inspect the charts of these stocks to see if they have the right pattern. Now, I've taught you a little bit about what the right pattern is, but let's practice. So, is this stock breaking through resistance? Unfortunately, no. It's starting to build some rising bottoms, but it hasn't broken out yet. So it's not good enough. So I go to the next one. All right, Genworth Financial has pretty strong resistance in this zone, And although it's starting to move a little bit, it hasn't broken out. I like that it's building optimism. I like that it's trading sideways, but it still needs to make that breakout. So I go to the next one. And with practice, you will start to see these patterns. So LFMD, it's got good stock scores, but it made its breakout from a predictive pattern about 2 weeks ago. This is called a pennant pattern. So it had abnormal volume, it had abnormal price action, and it broke through this downward trending line of resistance. It had optimism, the bottoms are rising. It's been going sideways for 2 months. So anywhere between that 490 or even the 540 zone was the buy zone. Now the stock's at 660. I don't want to buy it now because it's not breaking from the low volatility. That's one of our rules. So I go to the next one. And I do this every day, scanning through markets, looking for stocks that have the right pattern. And most of them will not. I can go through 100 charts and maybe find 3 or 4 sometimes. In a good market, you'll go through 20 charts and find 10. It just depends on the market condition. I just wanted to show this one. Here's another example of how the stock market isn't fair. Here the stock starts trading abnormally, sideways trading, optimism, abnormal action, breaking through resistance, abnormal volume coming in, stock scores moving up, $17, and it looks like this stock is now a buyout, probably at $24. I haven't read the news on this, but I can just tell by the chart that that's likely what's going on. Okay, so I'm going to zip through these and see if there's anything good today. Now we have a bit of a difficult market for position trades right now because the overall market is moving lower. We have some sectors that are doing well, like uranium, for example, and then the energy sector has been pretty good. We're going to do a scan in the Canadian market that will look at some energy stocks in just a moment. Here's another example of one that was good a few months ago. Here you have sideways trading, optimism, abnormal volume, abnormal price, good stock scores, breaking out, and it's been outperforming the market ever since. All right, VMware, not bad. Sideways trading, rising bottoms, breaking out, abnormal volume. So that looks pretty good. When I see one that I like, I want to take a look at it on the 3-year weekly as well. So here you can see the 3Y. I'm going to click on that, and it's going to give me a 3-year weekly chart. And I can see that this stock is actually breaking out through a very long, what we call a cup and handle pattern. So that actually looks quite good. Now, I would prefer to be a buyer down here when it first made the breakout. So I feel like it's coming in a little bit late. So I would give this a 6 out of 10, which means I think it has a 60% chance of moving higher from here. Here, it was more like a 7 out of 10 because it was just getting started, had good potential to move up to this resistance zone where it was likely to get stuck. And it did get stuck. It traded underneath that resistance for almost 3 months. And then this week it's breaking out. Okay, now let's go back to the daily time frame. I'll actually zoom in on this a little bit, 6 month. Let's assume we're going to buy it today. And again, I give it a 6 out of 10, which is, it's good, but it's not as good as I like, I would say. But let's just pretend that we're going to buy this tomorrow. So our entry price is going to be somewhere around $179 a share. So now I want everyone to think about where is the floor price that we're going to use for our stop loss. Where is the floor that the stock made before it started to go up? Okay, and the answer is right around in here. You can see that for a while there, around 164 was our floor. So if I'm buying this here, I'm going to plan to lose at 163.50. If the stock closes below 163.50, I'm going to take my loss and move on. All right, so I'm going to buy at 179 and I'm going to plan to lose at 163.50. So my risk per share is $15.50. That means if I buy one share, my potential loss is $15.50 plus commissions. If I buy 10 shares, my potential loss is $155. If I buy 100 shares, my potential loss is $1,550. How many shares you buy is dependent upon what your risk tolerance is. If your risk tolerance is $150, that's how much you're comfortable losing, then you buy 10 shares. 10 shares of a stock that's trading at 179 is going to cost you $1,790. All right, so that is the whole risk management position sizing concept that I promised I would show you. All right, so that is a scan on the US market. I'll just finish. Here's another one that looks not bad. I say not bad because it's missing the abnormal volume. It has a pretty good pattern. Rising bottoms, flat top, starting to get through, but it needs the excitement. It needs that abnormal volume to really show us that it's going to go up. I think it's probably just got good momentum and will continue to move higher, but I don't consider it a screaming buy. Let's keep looking here. That one's not really breaking from low volatility, nor is that one. All right, so that's a scan on the US market. Now, let's do something on the Canadian market. So I'm going into the market scan, and I'm going to not select a preset. I'm just going to make my own here on the fly. That's something you can do with this tool. I'm going to say, show me all Canadian stocks that have a sentiment score greater than 60, but this time I'm interested in stocks that pay a good yield. So I want to know stocks that have a yield of greater than 5%. And because I want stocks that are fairly actively traded, for Canadian, I'm going to put at least 200 trades. Now I can change these if I need to. It's just it's a starting point. We can always evolve the scan as we need to. All right, and it found 13 stocks. So now let's go through these to see if they have decent chart patterns. I'm not going to be so fussy about the chart pattern because I'm really interested in these things for paying me a yield. So as long as they look relatively stable, then I'm interested. All right, so here's Pine Cliff Energy, and you can see that it's been pretty stable for the last 8 months, and it's building rising bottoms, and it's starting to move a little bit. All right, so I'm going to get paid to own this because it pays a yield. Now you see here I don't see any yield numbers. If I change my view from this is called the slideshow view, if I change it to gallery, I'm also going to be able to see the yield. There it is right there. So its historical yield is 8.78%. So if I buy this and it continues to pay the same dividend that it's been paying, I'm going to get almost 9% yield on this stock, and it looks like it has a decent chance to go higher as well. Okay, so that looks pretty good if you're looking for a dividend pair. Let's go on to the next one. Peyto. All right, it is in a good upward trend. It's got good momentum. I would think it's got a decent chance to actually pull back a little bit in the short term because it's running away from its trend line. You can see when it runs away from its trend line, it usually pulls back a little bit. It's a very common thing. A big part of what I teach is stuff like this. But it's paying a 9.5% yield. I think if it came back to 1370 and I wanted a stock with yield, good candidate. Okay, sorry, I missed a whole page of things here. Let's go back to page 1. IPO. So let's look at the 3-year weekly. I've looked at this one before. I like the pattern. It's shifted from falling tops to rising bottoms. Okay, so pessimism to optimism. Needs to break through this sort of 275 zone, but it's stable and it's paying a decent yield, 6.67%. Okay, so we're seeing a theme here. A lot of energy stocks show this. I don't love this chart because it's kind of broken down the last little while. Move on to the next one. Here's another energy name, Cardinal Energy. Very similar chart to IPO. It's shifted from falling tops to rising bottoms, pretty stable the last 4 or 5 months, paying a 9.7% yield. Maybe doesn't have the upside of IPO because it's got some resistance here, which isn't that far from where we're at now, but still pretty good. So these junior energy companies in Canada are showing pretty good yields and decent chart patterns. I'm going to see if I can find another one here. Let's go to the next page. Peyto we looked at already. I want to see a little bit of optimism in the chart. I don't see much else. So there was 3 or 4 stocks that are paying high yield, reasonably actively traded, so not too hard to move in and out of them, and have stable charts. And so we just applied basic chart reading skills and also factored in the yield to come up with some ideas in that way. All right. Okay, so how do you learn all this stuff? Well, I've created an online education center where you can learn the basics of analysis, of risk management, of sizing your positions, knowing when to buy, when to sell. That's all in the foundation part of the education center. Then we have strategies, the specific rules for when to buy, when to sell, how to size your position. That's all covered in the strategy section. So let's jump into that website again quickly. I go to Trader Training, Education Center, and as long as you are an investor member, you can view the theory here. There's a written lesson, there's a video, there's a assignment, and there is a test. Look, I got 100%. Hooray for me. All right. If I go back into the education center and go down to the investor section, here you see the different strategies we talked about. The Stockscores Simple Daily, one that you're going to do anytime during the day, probably better in the afternoon. You can do it in the evenings, you can do it on the weekends. Stockscores Simple Weekly, pretty much a strategy you run on the weekends. Abnormal breaks, good one to do about an hour before the market closes. ETF can do any time. Bottom fishing can do any time. Action breaks you can do any time, a little better at the end of the day. And for each of those, there is a write-up and there's a video. There's no lessons because ultimately your lesson is just to pick the stocks. All right. There's also a lesson on when to sell. Here's the investor exit strategy lesson. That'll teach you when to exit these things. Now, last night we talked about active trading. For those that have an interest in that, we have the active trader courses, or strategies rather. There's the exit strategy, and then all of the buying strategies. Now, do we short sell? I'm often asked that. I have strategies for short selling. Generally speaking, I prefer to buy inverse ETFs when the market's going down. So there are exchange traded funds that go up when the market's going down. So as an example, this one goes up when the biotech sector is going down. And so I would rather buy it using the same concepts we've talked about, breaking out through resistance, from optimism, from low volatility. This is benefiting from the biotech sector in the US going down. In August, it was at 17. Now it's at 24. You're still betting that the market's going to go lower. You're just buying something. It's easier. It's something you can do in a normal brokerage account. You don't have to have margin. When you're short selling stocks, you have to have a margin account, which not everyone has. You often can't margin. I don't think you can margin in retirement accounts and registered accounts. You couldn't used to, maybe you can now, but as far as I remember, you can't. So that's why these inverse ETFs are quite valuable. And there's inverse ETFs for all the markets. So if you want to bet against the small cap market in the US, TZA, you just do a Google search for inverse ETFs, Canada, inverse ETFs, US, and someone will have put together a list that gives you all of those. Now the investor course, what does it cover? Gives you the theory, that's the foundation lessons. It gives you my specific rules for when to buy, when to sell, that's the strategies. It gives you access to the market scan tool. With the course, you get 6 months access to the tool, And then every year that you want to renew is $300 a year. And that just keeps giving you your access to the market scanner. We don't make any money on the tool. It's just $300 a year is what pays data fees, because I have to buy the data from the exchanges, and they charge you a lot when you redistribute data. I pay like $6,000 a month for data, and that's how we cover it, is just with these fees here. All right. Now the active trader course, more what we talked about last night, so I won't spend a lot of time on this. I will go through these courses and what's in them in more detail on Saturday. So if you have any interest, make sure you attend on Saturday, because I'll walk you through the tools a little bit more. I'll walk you through the courses a little bit more, tell you what you get, what all the different costs are, what the benefits are. That's all going to be Saturday. So if you haven't already registered for that webinar, make sure you do so. Just go to the Stockscores website, go to the homepage, go down to the bottom, and here it is, how Stockscores tools and education can help you make stock market profits. You just click on that and register online, and you just register there. Okay, you've all done that already because you're here, so I don't need to go into that in more detail. All right. Now we also have a service called Active Live. I'll talk more about this on Saturday. It's our really compelling service for active traders, because I've built an automated system that gives you the trade alerts. The computer does most of the work. You get the alerts. I teach you how to filter the alerts to pick the best ones. And as an example, today on the Alpha Echo strategy, one I talked about last night, we had, I think, 4 buy signals, and one of them went up as much as 11 times risk. One went up 6.6 times risk. One of them's at about break even, but still a hold. And the other one went up, I think, 3 times risk, maybe 2. So, just using the exit strategy that I teach, you'd still be holding 2 of them and be up maybe 2 times risk. And the other 2 you would have sold for a total of 10 times risk. So that's just in one day. And that's exactly what I talked about last night. I will show some more of those results on Saturday. All right, so how do you do this? Or what's the bonus that you get if you register for the courses now? Twice a year, I teach live in person. It's a great way to get up and running with the knowledge. I call this like the express version. It's me getting you through the material as quickly as possible, because everyone procrastinates. So I'm going to make you go through it. We're going to do 2 1.5-hour classes, one on Monday, October 23rd, and another one Tuesday, from 6 p.m. Pacific time until 7:30 roughly. And I'll walk you through all the concepts. Then we're going to practice the strategies doing market scans together. Wednesday night, Thursday night, and Saturday morning, we're going to do market scans together. And we're going to actually pick stocks, and I'm going to show you how to do it. We're going to do different strategies. So that's for the investor students and the active trader students if they want. Now for the active trader, we also give you a month of access to the Active Live service, where I'm going to coach you for the month. I'm going to show you the picks each day. The computer is going to do most of the work. I talk for the opening half an hour and the last half an hour of the day doing the coaching. And that's, again, a great way to get up and running. Now, all of these classes that we're going to do that week of October 23rd, those classes are all recorded. So if for some reason you can't make it one of those evenings, don't worry, you can watch it as a recorded version video later. Or if you want to watch it again and again and again because you want to make sure you understand everything, then it's there for you as a recording. Now the bonus is that anyone who registers prior to Thursday next week at 11 p.m. Pacific time, you're going to get all of these live classes for free. So you get access to the express classes on Monday and Tuesday, and then the market scanning classes Wednesday, Thursday, and Saturday. And for the active trader students, you're also going to get a free month of Active Live that you can use at any time. You decide when you want to do it, whenever you're ready. Plus, we're going to give you a $500 discount that is good until October 19th. So until Thursday next week, Now, 11 p.m. Pacific time, that's the cutoff. That's when these things don't work anymore. So when you go through the checkout, you put in this code. If you're buying the investor course, you put in that code 500 ITA 23, and it'll just take $500 off the price. On the active trader course, $500 off of the price. The price is $3,995 for active trader. That includes the investor course. You don't have to buy both. If you've already done the investor course and you want to upgrade to the active trader course, the upgrade is $1,250 with that discount. Okay, with both of these, you get 6 months access to the tool, and then after 6 months, it's $300 a year. When you fill out the purchase on the website, it'll look like you're paying $300 now. You're not. That you get it for free for 6 months. The receipt shows $300 for the membership, but that's after 6 months. You don't have to pay that initially. All right, so to register, you go to the Stockscores website, very easy, go to Trader Training, learn how to trade. You can watch a video on the Active Trader course, you can see more details there. You can watch a video on the Investor course, see more details, and you can purchase it right there. Just click on Order Active Live. I put in that discount code, what was it, 500 ITA 23, I think that's what it was. Apply discount, there you go. So now the price is knocked down, and then I would go to the final checkout. Here you see the membership cost of $300 a year. Again, you don't pay that for 6 months, and you can cancel at any time. You don't have to renew if you don't want to. All right, so that is a little breakdown of my approach. Next thing we're going to do is I'm going to appraise your stocks. So if you have some stocks that you're interested in, want my opinion, you can now punch in the symbols. I always get tons, way more than I can do, so I won't be able to do them all, but I'll try to pick a few common ones that most people will be aware of. While we're waiting for that, I'm going to just launch a poll here. As I said last night, I'm not really into bugging people if they don't want me to send them emails. I won't. So if you would like a follow-up email on either of the courses, just let me know which one. If you've already responded to the poll, you don't need to do it again. If you were in last night's webinar or Saturdays and you've already answered this, you don't need to answer again. But I'll leave this up for a minute here, and then we shall look at some stocks. So there's a few being punched in here. We've got Synovus, AMC, Apple. We'll do those in just a moment. Someone found a stock that pays a 20% dividend, GECC. I'd be a little worried about that because the dividend seems high, but I'll take a look at that. So I'll take this poll down in another 10 seconds, and then we'll look at some charts. And we're going to start with, let's start with Synovus. All right, so I'll take the poll down now. Thank you for answering. And we'll close this down. Okay, so you should see on screen the chart of Synovus. So first thing, who's in control, buyers or sellers? Well, that's pretty easy. Buyers are in control because the bottoms are rising. We've been stuck in this sideways range for the last 6 weeks, and the upward trend line has been broken. So I would say it went from being bullish here to neutral to slightly bullish through here. It still isn't an upward trend, but it stalled a little bit the last little while. Now I'm going to take a look at it on the 3-year time frame because I want the big picture. And I would say that this stock is a hold if you own it, but it's not really a buy because it's bumping up against this resistance, and it may roll over here. Now, if it can break out through this, then I get interested again. I am a little concerned about this resistance over here. So I think it's good. I think it's a hold. I would not buy it here. All right, next one is GNS, which is a very actively traded speculative stock. You can see it's been bouncing all over the place. We trade this a lot in Active Live as a day and swing trade. I don't love it as a position trade. I just don't think the chart is great. I'm gonna have to zoom in a little bit because it's got so much volatility. Let's take a look at it on the very short term. This is a 1 month, 2 hour chart. And you can see that it's quite volatile here. It made some decent gains today on some good volume. So that's intriguing. That may carry over into tomorrow. I think it's a stock to watch for a day trade or maybe a swing trade. I would not buy it for a longer term trade right now because I think there's just a little too much uncertainty around it. All right, next one is TSX listed stock, HPS. What happened? T.HPS. That one does not come up. Maybe it's V.HPS. Nope, so it must be the wrong symbol. Let's move on to Apple. All right, so Apple, here, remember we talked about sell signals? Here's the upward trend line. Here's the break of the upward trend line. Since that happened, that was your sell signal. Since that happened, what's the stock been doing? Generally going down, right? The trend is down. So this is a stock that I would avoid right now until it can start to break this downward trend line, which it's at right now, after the build of a rising bottom. So what you want to see is this downward trend line get broken after the build of a rising bottom, and it hasn't done that yet. Question, typical intended hold time for position trades? I would say anywhere from 2 weeks to 3 or 4 months. You know, this one longer. This would have been a hold for 5 or 6 months, but that's a good sort of window. All right, let's take a look at Bank of Nova Scotia on Toronto. BNS is the symbol. All right, this is a stock to avoid. Who's in control? Sellers. Falling tops, it's pessimism. As long as that's the case, stay out of it. It is a little bit oversold because it ran away from its trend line, and I think you could see it bounce back here, but ultimately it needs to build a rising bottom and break that downward trend line. All right, let's try this GECC, which apparently pays a 20% dividend. I'm just looking here to check that out. Dividend is 14%, so not 20. The chart's a little choppy. Yeah, I don't know that that dividend is safe. Oftentimes when stocks go into downward trends like this, their dividend is based on where they were trading back here, and they often cut their dividend. So I wouldn't have confidence that they're going to keep the dividend up. So I'd be a little wary of that. I do like that it broke its downward trend line. I'd like to see it break out through this 1050 level. If it can do that, it's actually not bad as a consideration for a buy. All right, let's do 2 more. AMC, which is a very actively traded stock. You can see it's really been beat up the last little while. It's been moving up over the last week because that Taylor Swift movie is going to hit the theaters, and it's widely believed that that's going to be lucrative for AMC, which is an owner of theaters in the US. So as a swing trade, I picked this as a swing trade on Active Live right here, and it's been moving up nicely since then from $9 to 11. I think it's a hold as a swing trade. I would not buy it as a longer term trade, but I would hold it if you're in it. And until this upward trend line is broken, it remains a hold. All right, the last one we're going to do, where was it here? We'll do another Canadian stock. I think this is Tourmaline, which is another oil stock, TOU. So here you can see underneath resistance, this is called a rectangle consolidation. So it's one of those dozen patterns that I've told you I teach. It had a good breakout back here, which led to this move. It's now stuck inside a sideways range. Let's take a look at the 3-year. Yeah, it's good. It's not great. It doesn't look like it wants to go higher, but it also looks relatively safe. But the yield's only 1.5%. So to me, if I was going to own an energy stock, I'd rather get something that pays me more of a yield, some of those ones that we talked about. All right, so I'll leave it at that. Let's go back over here and I think there were some general questions that I'm just going to check for. Maybe there wasn't. Anyway, here's a couple of things that people have emailed to me. I've been teaching for over 20 years, and I've had a lot of students. I don't teach a lot of people every year, maybe 100 a year, but when you've been doing it for 20 years, that's adds up to a couple thousand people that I've taught. And I still have, students from 20 years ago still subscribing and using our tools and participating in the things that we do. So I think that's the best sort of vote of confidence that I can get. Which investor strategy currently works best? I would say I like the dividend one because I think it's paying you to own some of these stocks. And abnormal breaks or the abnormal activity breaks are probably the best thing to do right now. But you really have to be patient right now and quite picky because the market is in that downward trend. We haven't broken the downward trend yet. So you want to make sure that you're patient and wait for that downward trend line to get broken before you get too aggressive. Swing trading, day trading, working quite good actually, considering the market. Position trading, you got to pick the right sectors. So uranium, energy, or the inverse ETFs is obviously been doing well. Things like LABD and TZA, those have been doing well. But otherwise, be pretty picky right now until we get the break. Typically, the market makes that break in October, seasonally wise. So you'd usually base out in October, maybe November, and then start to rally in towards the spring, May, June. So the typical seasonal cycle is that, and we're seeing signs of that happening, but it hasn't really given us the conclusive evidence yet. And make sure that you're subscribed to my YouTube channel because I do a weekly video every week where I talk about that stuff, where I talk about the trend of the market, what's working now. I show examples. I teach something every week and it's free. So go to YouTube and make sure you're subscribed to the YouTube channel. All right, so I'm going to leave it at that. I want to thank you all for joining me tonight. And again, register for Saturday's webinar. I'll dive a little deeper into the tools and how they're used and what their costs are and all that sort of stuff. It's going to be an important one for anyone considering taking any of my courses or using any of my tools. So Saturday is all about that. We start at 9 or 10 a.m. I can't recall. Let me just check that. On Saturday, we are at, I believe it's 10. Saturday, 10 a.m. Pacific time. And so you can register right there on the Stockscores homepage. All right. So thanks, everyone. Hope you've enjoyed it and trade well.